For nearly a year, the global stock market felt invincible. Artificial intelligence was driving equity valuations to historic heights. The Dow Jones Industrial Average was coasting comfortably above the 50,000 milestone, and Bitcoin was holding strong. It felt like the party would never end. Then came the first week of June 2026. In just 8 trading days, a rare alignment of structural, geopolitical, and macroeconomic forces collided to trigger a massive panic, wiping out a staggering $3.3 trillion in market value from the S&P 500. This is the story of how the storm was born. Act 1. The SpaceX Vacuum. The storm began quietly, behind closed doors on Wall Street. It started with the upcoming SpaceX IPO. Slated to price on June 11th, the listing was the most anticipated event of the decade. It was massively oversubscribed by 4 times. To secure a piece of Musk's aerospace giant, institutions needed billions in liquid cash, and they needed it immediately. Algorithmic trading desks began systematically dumping their most liquid holdings. First, they targeted the digital asset ecosystem. Bitcoin was ruthlessly pushed below $62,000, dragged down by a brutal $4 billion outflow in just 1 month. Next, they tapped the stock market's golden goose, artificial intelligence. A sudden wave of selling triggered a historic 10% flash crash. In total, the chip sector shed $1.3 trillion in days. The market was being hollowed out to fund a trip to Mars. Act 2. The oil shock. A sudden geopolitical catalyst transformed a controlled capital rotation into a full-scale rout. Overnight, military strikes were launched. The reaction was instantaneous. Brent crude oil spiked violently to $93.10 a barrel. Skyrocketing oil prices act as an automated tax on technology. Energy-intensive data centers suddenly faced soaring utility cost projections. Systematic trading models executed massive sell programs. NVIDIA plummeted 3.7%. Supermicrocomputer cratered a staggering 28%. Terrified of a broader war, capital aggressively fled risk assets. It sought shelter in legacy consumer staples like Coca-Cola. Act 3. The Fed Trap. By Wednesday, June 10th, the panic reached a boiling point. Investors looked to Washington for a lifeline. Newly appointed Fed Chair Kevin Warsh had a mandate to cut rates, but the macro data trapped him. Sticky inflation meant the Fed couldn't cut rates without risking a secondary inflation wave. Instead, markets priced in unexpected hikes. As the U.S. 10-year Treasury yield climbed, the math for stocks got ugly. Today, the dam finally broke. The Dow suffered a brutal 953-point collapse. The Nasdaq plunged 1.98%, and the Fear and Greed Index slammed into extreme fear. The aftermath. In just over a week, $3.3 trillion in wealth simply evaporated. To the retail investor, it looked like the end. But beneath the red screens, the signal remained clear. The market had experienced a violent, overdue structural flush. Local market bottoms are forged in the fires of capitulation. Once the SpaceX cash allocations settle, the vacuum will begin to fill. Until then, as institutional traders say, cash remains a valid position.